Hello, everybody. Adam Parks here with another Receivables Info webinar. Today, I'm here with my friend uh, Scott Hoffman, who's here with Harvest Strategy Group. Scott and I are going to talk a little bit about Can you hear me, Scott? You can hear me now? All right, I can't hear you though. Well, and I promise you that we literally just tested this before we jumped on our call here. We were sitting here having a chat, but that's the way technology goes these days. If try modifying it top right hand corner in the settings. If that doesn't work, log off, log back in. It should fix it. But in the short term here, I'll kind of talk a little bit about kind of our outline for today while we're getting the audio connected here. But ultimately, from a litigation standpoint, managing the law firms, I think we all see the wave of accounts that are coming. And so for those of you that have watched the receivables roundtables, you've probably seen the one that I just did with Marion, talking about the increase in volume that's expected, to be hitting the industry, and especially looking back even just last month and looking at auto loans reaching delinquencies that are 1994 levels, which again was the last time that we were seeing interest rates like this. Can we hear you, Scott? No, try dropping off and jumping back in. We'll kind of hold it here for a minute. But with that increased volume that's coming, I think a lot of organizations are thinking about the railroad tracks that they need to lie. And what I mean by that is, with the increase in volume that's coming, having the technology rails that allow us to push more accounts through our systems and processes, becoming more systematic and more standardized in our capabilities, I think is going to be a really important factor looking at this increase, because there's always this balance of really collectability and the volume of accounts. And if we're going to start looking at this really high volume of accounts that's coming, we need to prepare that. Oh, it looks like I can hear you now, Scott. How you doing?
Can you hear me now? Good
I
morning. Good afternoon. Yes.
So, Scott, can you tell everyone a little bit about yourself and how you got to the seat that you're in today?
Yeah, sure. So I've been in the industry about 20 years, a little over 20 years. I started out at Resurgent Capital, and I kind of worked my way through the ranks. I started out as an auditor and was there for a while, and then went into performance management. And after about 13 years at Resurgent, I moved over to Harvest in a performance management role there as well. I've been in Harvest now, it'll be 10 years this coming May. And I've been in a performance management role, different levels, but that whole time, I just recently moved over to the client success side. So I'll be working more with clients, but I've got 2 decades plus of both litigation management. Don't have as much agency management, but in my early years on the audit side, I was definitely able to go in to a number of agencies across the country and see on site how they did things. And then same thing with firms too. So I've really kind of been behind the scenes as well as kind of in front of both firms and agencies from a management perspective as well. And so I hope that makes me qualified to be your guest today, and we'll see over the next hour or so here. But yeah, that's where I am now, and we're excited about where we are, where Harvest is, and what the future looks like.
Let's talk about Harvest for a minute. Tell everybody a little bit about Harvest and what it is that you guys do there. I think it's important to set the stage for your perspective.
Yeah, for sure. So Harvest is a network. We manage a network, both litigation and agency. The primary work that we do is on the litigation side, but we certainly have an agency component as well that's actually grown pretty substantially just this year in 2023. But yeah, we cover, I mean, name a vertical, we touch it, we cover it. We started out as kind of heavy on auto paper. And that's still, I think, our biggest segment in terms of what we work. But, we certainly work all the new and fun things, fintech. We've worked medical in the past. We've worked student loan in the past. We certainly work bank card, credit card. That's still a big chunk of what we do. So we kind of touch all segments, and that gives us, I think, a good perspective on, where the industry is and where the industry is going, because we touch so many of those facets.
Well, I think you guys have a unique point of view in which the way that you're doing things. So, as a master servicer who's handling both that litigation and the agency side, I think being able to talk about the KPIs and those management tools are incredibly important.
Yeah.
And there's nothing quite like getting, cutting your teeth in the space, actually conducting audits, because it's not then just about how does your company operate. It gives you a perspective on how all these different companies operate. I know my
Yes.
own perspective changed exponentially through the process of building Compliarm. Right, going out there conducting those audits really does give you some interesting insights into how the nuts and bolts actually function in the watch, so to speak. Now, when we were first talking, I think you're very qualified to talk about it, because I got really excited when we were doing our planning call and just kind of going through an outline of some of the things that we wanted to discuss, because I felt like your perspective was really unique. So let's kind of kick it from the front. And when we talk about KPIs and performance management, I think one of the things that gets lost in the discussion is screening for that stuff up front, right? Like, what can you do up front in your pre-screening and onboarding processes to identify those groups that are most likely to be successful, right? Because it's all about the focusing of your available resources. So let's talk a little bit about how you identify not necessarily a good or a bad organization, but a good or a bad fit to an organization.
Yeah. So, when looking at onboarding a firm specifically, it's generated. The idea is generated by a client need. We have a client that needs that's placing a new type of business that we currently don't have coverage in certain states. That's the unique thing about firm versus agency, right? Is I could go get agency ABC today, and 99% of them cover the entire country. If I have a need from a client in a state where we don't think our current firm is a fit, or maybe temporarily we don't have coverage in a state, that's a whole different story, because firms, you have to have licenses within a state. Obviously, a lot of firms have multi-state, but some firms specialize in individual states. So, okay, so that's the first thing I do is I identify what my need is, whether it's from a client or from, Harvest has a need, we need coverage in whatever that state is. We go out and the first thing we do is we send that firm a questionnaire. And the things that we're looking at in the questionnaire are obviously the basic demographic information, giving us key contact personnel, what's the accounting process look like, all that sort of stuff. All the compliance boxes are checked. Do you have cameras? Do you have 4 walls? Are you actually in a building without a tent? That sort of thing. But one of the key questions that we have in our questionnaire is, what do you consider your core competencies? I want the firm to sell themselves to me. What are you good at? If this client that we're bringing on is an auto client, I want to make sure that the first thing they say isn't, we do 90% medical. Well, that's not going to solve my problem. I need them to tell me, we do all and that's actually one of the questions too, is can you give us a breakdown of your current inventory as kind of a pie chart percentage?
Sure.
So we can see, hey, it looks like these guys have experience. They know what they're doing. They answered the other questions correctly or adequately as well. But we want to know what that mix of clients looks like, and what streams they're working in, and what streams they work in most. And then, and we talked about this when we met last week, one of the key things, just like anyone that you're hiring, any person, any FTE you're going to hire for your organization, I want referrals. I want current clients. I want perhaps, former clients. And just because it's a former client doesn't mean it's a bad thing. That doesn't mean you were fired. It just means maybe things didn't work out. But is that someone that can give me some good insight into how you do things, how you run your operation? And if so, that will give me more of a perspective on what I can expect from you as a firm. Again, this applies to agencies as well. And so once all of that is done, we kind of take those resumes, if you will, and we sift through them and we say, okay, this is the one that's the right fit. And you want to do that up front, because the boarding specifically of a firm is a very long and involved process. And you don't want to just say, well, we heard that's a good firm, let's bring those guys on. Because then you're spending 60, 90 days of your entire organization's time and resources And you might get to the end of the line and you start placing inventory, and then 6 months down the road, it's like, this wasn't a fit. These guys don't know what they're doing. This isn't the right firm for us. So it's really critical to have those upfront conversations to determine, again, boiling it down to determine what the skill set is, the critical skill set of that servicer that you're looking to board, what that skill set is, and make sure that it fits in with what your needs are.
Well, I think it's an interesting approach, right? And I like the idea of the referrals, but I also find that when an organization is quote unquote hot, then they're not able to necessarily scale rapidly, right? Like their successes come through slow incremental growth, and when they're quote unquote hot, now I'm not going to be able to get at those premium resources that are available, right? Because
Right.
every collection floor has that 20% top performers, right? Like we all kind of understand the breakdown of the individual collectors within an organization. But I
Yeah.
feel like that kind of methodology, even though that methodology is slightly different as you're dealing with a law firm. Now, how do you start to skim that beginning of the funnel, right? So before you're even investing time into the questionnaire, is that like something public that like every organization can go and do, or is there a kind of a prompt to drop somebody into that, or is it just strictly related to client need at that time?
Well, I mean, it can happen a number of different ways, but typically the way we have done in the past is, we are at NCBA, we're at RMA, and in our marketing material communication in advance, whether
Hmm.
we're having an individual meeting or not, we will say, hey, this is an open meeting. We invite both current firms and prospective firms to attend.
Okay.
We have needs in this state. So a firm will know, and more on this in a second, but a firm will know coming in, hey, I work in that state. Let me talk to these guys after their presentation and give them a business card and start that open line of communication. Now, what I was going to say is that doesn't prevent other firms from coming in and giving us their card and wanting to get in the network. And that's fantastic. That lets us know that, hey, we're doing something right. We have firms that we
Sure.
haven't even asked for, that we don't have needs in those particular states, and they're still coming up and saying, we want to be part of what Harvest is doing. We want to be part of the Harvest growth, and trying to present themselves as a prospective firm that we can onboard. But that's typically the way that it's done.
Hmm.
If we have a need outside of kind of the conference cycle, we certainly have plenty of resources, because the Harvest executive team just has a bunch of time
I
and
know everybody. I mean,
tenure.
well, because you guys, the team has been around for such a long time that you have the personal relationships. You generally know where to
Right,
go for some things, but you may be
right,
looking to dig a little deeper for specialty type items.
exactly. And look,
Makes sense.
it's a small industry, right?
Hmm.
Both agency and legal side. I feel like I know 90 to 95% of the firms out there, and our agency side knows 95% of the agencies. But new agencies, new firms are being created all the time, and
Hmm.
you never want to be the first client for a new firm, but it doesn't mean you can't give those new guys a chance, because new typically also means younger, and younger typically means they have more of a drive. They want
Hmm.
that business. They want to grow their firm. They want to grow their agency. And you can only do that by bringing on new clients. So while
Hmm.
I may know I have a need in this state, and here are the 3 firms that everyone uses in this state, well, now there's a 4th firm. I don't want to
Hmm.
be that first client, but if they get a couple of clients early and they start proving themselves, I want to get in early
Hmm.
while the getting's still good, so that I can get some of those
Gotta get the
resources,
resources.
and they
Yeah.
can provide for me, and they can produce for us as an organization. Yeah.
That's really interesting. Now, when you do the open meetings, I've been to some of these and I've held some of these through the years at both of the conferences that you mentioned.
Yeah.
Any tips or tricks for successfully running one of those as a as a placer, as a master servicer?
Yes. My main tip is pretty straightforward and pretty simple, which is you shouldn't be too specific, but you shouldn't be too broad. And I know that's
Okay.
probably sounds kind of dumb, but
No, it's balance.
let me explain just briefly.
Please.
Because it's open, you can't be too specific. You can't talk about,
Hmm.
well, for this client, we collected X number of dollars this past year. That's
Sure.
obviously that's stupid.
Yes.
You can't do that. And you never know who's in the room. Even
Hmm.
with badges, even with security guard, big security guards at the front door, people still find their way in. And so you never really know who's in the room. So you can't be that specific, but you can't be too broad either. You can't just say, we're a network and we're looking to place business and we do things great. You have to give them
Hmm.
some metrics. You have to show people, here's where we are, here's where we've been, and here's where we're going. And that's why we want you to join our network. That's why we want you to be part of this growth. And for those of you who are already here, thank you. Thank you for what you've done for us. And we always, NCBA now is just once a year. When it was twice a year, on one of those two every year, we would always give out awards, because as silly as it seems and as small as an investment as it is, those little, crystal trophies or fake crystal trophies, they mean so much to those firms. Every firm that I visited in my career as an auditor, or that I visit as a performance manager, those things are always displayed. And yeah, nowadays with the more aged firms, they have 50 of them, but that's fun to go and be like, oh, there's the award that I gave you. And they take such pride. And it's not, by the way, it's not just the partners at the firm. They bring those things back from the conferences, and now the entire company gets to share in the win that is, here's the trophy we're giving you, and here's why we're giving it to you. And especially if it's something like, it's not maybe, top performer from a collections perspective, it's, best back office or something like that. So
yeah, something that can drive pride.
Yeah, they can share that wealth, if you will, with those back office personnel who otherwise they never know. They never go to the conferences. They don't know what their worth is. But you come back and say, hey, this top client gave us this award because of what you guys did. That's great. And that fosters goodwill for us as a client too, because we're giving them an award. So now the whole organization knows, hey, these guys understand that it's not just the face of the organization, the part of the organization. It's a giant company that's making us all successful.
Well, and that appreciation is a two-way street. Right. Yeah. So they give that you're giving them these awards, but their level of appreciation of the client relationship, I think, can be enhanced as well. And that also ties back to what you were saying about the open meetings, because it's about selling yourself as a good client. Like this is it's setting your expectations firmly, right? And you're not delving from the expectations that you set. But I think that's an interesting way to look at it, right? Like it's going in there and saying, this is why you want an opportunity to work with us. Because I know at the end of the open meeting, you get flooded, right? Like we used to do with a fishbowl. I mean, I tried handwritten cards after the fact. I mean, I tried anything and everything to make those successful. And matter of fact, looking at the attendance of this particular webinar, I know at least more than a handful of you were in the room. Yeah. Which brings me to the audience here for a minute. As Scott and I are going through this discussion, feel free to ask questions. We love turning things into a discussion, and so I got the chat open here. So if anybody has any questions, comments, feel free to drop those in the chat. Other than I can hear now. So just want to keep everybody engaged in that discussion, if possible. So. We talked a little bit about kind of how to identify these new firms. We've talked a little bit about how to kind of evaluate those firms before you get into that onboarding process. And then everybody's onboarding process is like so unique that I'm not going to try and drag you through that portion of the conversation, because I feel like that's a little bit more. It's not really a KPI relation, right? Like that's an administrative function of connecting two businesses, and so I don't want to downplay the value of that. It's infinitely valuable, but not part of today's discussion. So the next thing I wanted to talk a little bit about was like managing new vendors, right? Because new relationships and mature relationships are going to be managed totally differently, right? So if you've got a new firm that's coming, let's start by talking a little bit about the differences or the contrast between those two worlds, right? A new firm that's day one getting accounts, and a firm who's you've been placing accounts with for 10 years. How do you view kind of the difference in expectations between those groups?
You just stole the words out of my mouth. Expectations is the number one difference between the two. And that seems like a given. But so a brand new relationship, we just finished boarding a firm, and now we've just given them their first placement. With almost 100%, it happens 100% of the time, there's going to be some sort of stumbling out of the gate. It's just it's a difficult process, right? It's a new firm relationship. It's now also, in our case, a new client relationship. And then hopefully we're starting to place multiple clients with them. And all of our clients are different. It's a new relationship with this firm. And so the expectations are, let's just, for the first 30, 60 days, I'm going to hold your hand and make sure that the EDI interface is working. I'm going to make sure that you understand our expectations, because that's something that you can have a conversation early on, but then you kind of get involved in that boarding process, and maybe there's a lack of clarity by the time it comes for the gun to go off to start the race, right? So I want to make sure you understand my expectations with all of the various clients that I'm placing you, whether it's auto, whether it's bank card, whether it's fintech, whatever, and make sure that you're just getting things started. And then from a medium term, not a short term, but a medium term perspective, I do expect some sort of liquidation. I expect recoveries. I expect you to get going once we've gotten over the initial hurdle.
Sure.
But I don't expect you to have the exact same level of success that a firm that's been in my network for 5 or 10 years is going to have, because that firm is seasoned. They understand the process. They've been through all of those hiccups. You guys as a new vendor are just now facing some of those hiccups and some of those potential pitfalls. So I want to have a little bit more grace in dealing with you to give you that ability to make those mistakes and correct those mistakes. If 6 months, even maybe a year into a relationship with a new vendor, if I have the exact same expectations between you and your competitor who's been with us for 5 to 10 years, that's not fair. It's not fair. Also, it's not fair to the more mature vendor, because depending on what type of business I've placed with you, and let's say it's one of those younger firms that I was talking about who has that real drive, of course, they might come out of the gate and crush it. They might have a couple large payments which could wildly skew what their percent to goal looks like. So it's there's no set number like, all right, at month 12, it's apples to apples. Not true. That's not true at all, especially in litigation. Agency, different conversation. But with litigation, it takes such a long time to get those costs out there, get the suits filed, get the service perfected, have judgments. It's a very long process. As I told you, and I say this all the time, you date an agency, you marry a firm, right?
Yeah.
We're both married guys. Like, it's a long relationship. You're in it for the long haul.
You're in it in the indefinite. Yeah.
Yes, you can't just take a small fight and leave. People do that in our society, but I suggest, as a marriage counselor now, I suggest you don't do that. But no, my point is you have to really stay with those firms and continue to push them and drive them. And again, it gets to a point with the KPIs, which we'll talk about here soon, that's kind of what you have. That's all you have to compare once that firm is now 12 months, 18 months, 24 months into their relationship with you. But you still have to understand how long these firms have been there and what their history is with the organization when doing those comparisons, because it's definitely apples to oranges at first, and it eventually becomes apples to apples, but you have to know when to make that switch.
So you had made up you brought up a really good point. This is kind of a curiosity question from my perspective, and that's you were talking a little bit about the kind of the normalization of data, right? So that you're comparing two organizations, and in this instance, we were talking about mature versus a new relationship. But even just taking a step back and saying mature to mature, right? If I was comparing apples to apples, are you normalizing the KPIs that you're using when comparing those? For example, if one firm gets a $100,000 payment, right, or is taking in a couple of small, like a low volume of large payments that come through the door, like, are you normalizing that in different ways when you're evaluating the KPIs?
We are because, and unfortunately, we don't have many clients where 6-figure payments are a reality, but we do have some.
Fair.
And that can be a complete game changer. That can not only change your month, that could change your year. It could change an entire year if you're doing like market share comparisons, just as an example. So in the exact case of what you were saying, if you know that something like that has happened for firm A and has not happened for firm B, firm A's percent to goal, like I said, for potentially 12 months will look much better. Does that mean they are the better firm? No. So the normalization, it might, but it doesn't necessarily mean that. So the normalization comes in with saying, okay, we know what happened with these two firms in this state. This guy got this large payment. This guy didn't. We kind of have to throw out percent to goal for a while and look at all these other metrics that they have.
Okay.
and again, not to jump into that, but are they
You
doing?
you pivot off the inaccurate measurement. That's an
Of
interesting.
course,
Yeah.
but that's the great thing about having multiple KPIs is you can pivot to something else because, I mean, percent to goal is super important. Dollars collected is super important, but there's
Mhm.
also many other things which we'll talk about which are super important. So if you feel that the other firm, which didn't have the large payment, still has better processes, and you think that's a better long-term play, maybe they will continue to have, let's say they already had a lead in market share. Maybe they'll
Mhm.
continue to have the 75 versus the 25 for the small firm. You give kudos to that small firm for getting that large payment, but just because you get one large payment doesn't mean you go from 25 to, and now it's 50-50.
Yeah,
It's not
fair.
that simple.
Right.
That's one account.
Yeah. Well, and that's why I was curious as to how you guys looked at that in terms of kind of normalizing that comparison between two organizations, giving an anomaly in the data set.
Yeah.
We did have one question come in that was asking about the level of importance for like SOC 2 certifications, for example, when going through that process, going through that onboarding process.
Yeah, I mean that's not my area of expertise, but I'm certainly familiar with that. I mean, and I breezed right past that, but I did kind of address it earlier when I said the compliance checkbox. That's
Mhm.
certainly those sorts of things are things that you definitely need to see, and that's almost like it's almost like
The
minimum requirement.
table stakes. Yeah.
Yeah, like you have to have that. If you don't have, and again, some of that is client dependent too. That's the great part about being a multi-client forwarder like we are is, and like now again, we normally will bring on our firms to meet the maximum requirements, whatever the compliance requirements are, so that they could theoretically get placed inventory from any client down the road. We don't want them to just meet the
Mhm.
minimum hurdle, because then 6 months later, it's like, hey, we want to give these guys client XYZ. And then we look back at the onboarding, and it's like, well, but they don't have, their insurance policy is too small. Well, now we have to
Mhm.
talk to them about increasing their insurance. They're like, I don't want to do that. It's too expensive. So you want to make sure they're as high level as they can be in terms of all that sort of stuff, the compliance, the IT
Mhm.
infrastructure, all of that. So yes, compliance with SOC 2, all of those. We look for all of that, and that could be. By the way, I didn't really touch on this, but if we had two firms that we were looking to board and we thought they were pretty equal, all
Mhm.
things considered, something like a higher insurance policy or a better IT infrastructure compliance type, that could theoretically make the difference if we had two that were very equal. So it's critically important. Of course, that stuff's important. Yeah.
So one of the things that we were talking about when we were planning, like on our planning call, was that how organizations generally are onboarding. And I thought this was interesting in the way that you are approaching the onboarding of a new agency. And so a lot of organizations have an onboarding team, and that's that team's function, right? There's a group of people at the company, 4 or 5 people, whatever, depending on the
Yeah.
size of the organization, and their job is to onboard new vendors.
Right.
But with that comes a disconnect between the vendor's staff and the people that they're going to be working with long term, which requires this additional transition. Talk to me a little bit about how Harvest has addressed that process, right? Of kind of shortening that gap of getting a firm from I want to work with you to here's your account, here's accounts to start working.
Right. Well, the first way is we've never had a dedicated onboarding team. Um,
Fair.
we've never even really had a dedicated individual that does that exclusively. Instead, and this is what we spoke about last week, is
Mhm.
during the onboarding process and even during the selection process in some cases, but certainly during the onboarding process, every department head is involved. And what I
Mhm.
mean by that is our accounting department, once the onboarding process has started, our accounting department is talking to the firm's accounting department,
Mhm.
already fostering that relationship before account one has been placed, making sure that they feel comfortable, that our internal accounting feels comfortable with how this new firm is going to be remitting funds to us and that sort of thing.
Mhm.
Obviously, IT and IT resources are involved to make sure the EDI, everything maps up, from that perspective. Our compliance team is involved. The the key difference, I don't know if it's a difference, but I think it helps lead to our success with new vendors is every department has a touch point, has a conversation, has multiple conversations with that new vendor from the beginning so that there
Mhm.
are no surprises when it comes time for them to get placements. And we're trying to not be reactive. We're trying to be as proactive as possible with answering any of those questions and resolving any of those potential issues before they get their first account.
That's interesting. From a timeline perspective, as you're kind of building things out, right, and setting an expectation, and
Mhm.
this to me is, I know it's not a direct KPI, but this kind
Right.
of ties into it. But like, how are you helping to convey the timeline expectations to a firm? Because one of the things I know we're going to talk about is speed to suit, right? And so I think this
Yeah.
is kind of our bridge into the specific KPIs. But how are you kind of working through that timeline and communicating those timeline expectations to the firms?
Timeline for the litigation process?
Yeah, at this point, like, so now they've got accounts
Sure.
coming in, right?
Yeah.
We've talked about kind of the onboarding piece. Now they're getting ready to work those accounts, and you've got some really specific guidelines as to what
Yes.
your expectations are. But how are you communicating those guidelines?
So I will say that I think within the industry, there's some pretty standard guidelines. Like
Mhm.
if I place an account with you today, I expect a couple of days for attorney meaningful involvement, and then I expect that demand to go out, assuming you have everything you need. Do you have all the media you need from us, right? And this would be
Mhm.
the same for any direct client relationship as well. Do you have everything you need to review to say, I agree with this balance. This is the human being we're going after. Let's send a demand letter. That should be done within the first business week, within 5 days at a minimum, right? And then, of course, you have the validation period. You have to wait, 30 to 35 days for that letter to be out there. And then you can start thinking about the litigation. Now,
Mhm.
that's when already things can start to wave a little bit because it depends on the state, right? For example, there are states where you have to ask for a file reference number before you're filing the suit. So there's an additional delay there. Some are very straightforward. Technically, on
Mhm.
day 36, you can send that suit packet out and it's filed, and the next day you send us the notification, and that's amazing. That's
Mhm.
not true in most states, but that is true in some states, and that's great. And then, of course, we have, there's serve first states. So in those
Mhm.
8 or 9 serve first states, we expect to see the service first before we see the suit. So in terms of the timeline of expectations, I think it's pretty standard within the industry how long we think it should take based on the state. And then what we do to monitor that, and we can get more into this later if you want to, is we have a series of exception reports that we have the built-in timelines, national average timelines
Mhm.
that we give a little leniency there too. So let's say it's 60 days after placement, we expect either a suit or a service. And we have the 5 days after placement, we expect to see a demand letter out. And so by day 10, by day 15, if we still don't see that demand letter, the performance manager,
Everything's behind. Yeah.
yeah, they have that list of accounts and they're calling the firm saying, what's going on here? Why don't you have the demand? And there's usually a reason, but we don't know that. The exception reports don't know that, exception reports
Yeah.
essentially a robot finding the exceptions. And
Sure.
so those things pop up. And same thing with suit, same thing with service, same thing with getting judgment, same thing with even dormant judgment. We expect our firms to continue to work and do asset searches and those sorts of things, even with those accounts that are now judgments. And we say dormant judgments, but if it's been a judgment for a while, we expect them to continue working it, right?
Mhm.
And the same thing there. So that will pop up. So our exception reports are really what give us, those are the reports that give us the knowledge that something is out of whack from a timeline. But the firms know what their timelines should be. It's very clear from the get-go. And again, with litigation, it's basically I place an account with you. My goal is to sue this account. Sue this account as quickly as you legally can
Mhm.
so that we can move down the path to get to judgment and then get to those post-judgment execution opportunities, which are what ultimately account for the majority of our ongoing payer base, our wage garnishments, bank attachments on occasion, liens, that sort of thing. Those are the things that continue to generate those funds well after judgment in the litigation process.
Interesting. So I think from what you're saying, you know, those timelines, keeping those timelines tight and keeping
Yeah.
them fairly standard, right? Because there's limitations to what the courts are capable of is kind of
Yes.
what is setting that. that guide. So, from the perspective of the kind of mature relationships, or we can kind of start talking a little bit more about some of the other KPIs that you're using to measure these firms. So we've kind of looked at that timeline and keeping them on track of moving forward. But what other metrics are you using to determine success? Right? Like what we've talked about, like it almost sounds like the staying on the timeline is table stakes as well, right? So like going
Yeah,
through the onboarding process, there's a lot of standardization there. There's a lot of standardization to the timeline that you're doing. But what other KPIs are you or other metrics are you ultimately using to determine success or not success?
sure. So first of all, I will say, because I failed to mention earlier, I will say that in 2020 and even in early 2021, all of this went out the window, and I'm glad that's behind us because that was a wild and crazy time. So I just wanted to put that out.
Yes, fair.
Timelines, and again, by the way, the ripple effect of that in certain states, it's even still here to this day. But certainly for a year or two after, just the delays and the lack of FTE in the court system. So anyway, I just want to throw that in there. I thought about it after I stopped talking
It's a
last
fair
time.
statement.
Yeah, it was a scary time. In terms of other KPIs besides timeframes, the first thing I'll say is that the first thing that every client should care about is money, right?
Mhm.
That's why we're in this game. They're placing their assets with us, and we are placing them with a firm to collect money to maximize recovery. How much are they making? They should also care about how much they're spending to make it, because filing suits is not free in this country, as most of us know. And when can they make that expenditure back? So in the spirit of that, obviously things like recovery percentage, percent to goal, all the payment details, by the way, broken payments, average size, average payment size, payer rate, those sorts of things are all critical. And it's interesting because those are typically things that you talk about on the agency side as well, just as apt in the legal stream.
Okay.
Our penetration rates is something that you don't really talk about on the legal side because they're not smiling and dialing as much as you would on the agency side. But other than that, all those key upfront metrics are just as important, including settlements. How many settlements do you have? How much are the settlements? What's the percentage? When are they happening in the life cycle? So I think that when you're talking about payment information, you're talking about 3 siloed periods of time. You're
Okay.
talking about pre-suit, you're talking about post-suit pre-judgment or a stipulation, and then you're talking about post-judgment, which is what I mentioned earlier, all of the garnishments, wage guard, bank guard, liens, all those sorts of things. So it's important to know when those things are happening. And it's interesting because based on not that it's true across the board, but based on the paper type, the majority of that money will come in at a different time, a different one of those silos. So, but it's important to know that. It's important for the client to know that as well. So, and then also, again, we were talking about timelines, but what percent of my accounts have been sued? What percent of my accounts have been served? What percent are in judgment? I have a number in my mind, and I've had it for years, about what I think on average nationally, an entire portfolio, what percentage should be sued, 4 or 5 years into a relationship. Some clients are higher, some clients are lower. There's a number of reasons why that might happen, but these are 100% things that you need to track, because the client needs to know, hey, as we continue to get more mature in this relationship, are we expecting that suit percentage to go up? Are we expecting it to go down? Are we kind of where we need to be? So that if I tell them, I'm 2 years into a client relationship and I say, hey, the first batch you placed is now 24 months old and we're at 60% suit penetration. A lot of clients might think, why are we not at 100? Well, there's a million reasons. We don't have time on this webinar to go through why you're not at 100. And I have to explain to them 60 is actually a really solid number. That's a good number for you guys because X percent fell out. They were closed for BK. They were military. X percent paid when within the first 3 to 6 months. A certain percent we sued but couldn't serve, so we had to dismiss the suit. Like, these are things that a lot of clients don't think about. They think, I'm going to start a litigation program. I'm going to place 100 accounts. I'm going to have 100 suits and 100 judgments and 100 payers. No, you're not. It doesn't work like that. So if I can convey to you suits, service, judgment, post-judgment executions, accompanied by the cost that we spent to get to that point with all of those accounts, and tell you why it's not 100% and explain to you why it's not 100%, that adds huge value to the client. You're educating that client on why we are where we are in that process. And so for that reason, we absolutely track all of that. We also track asset searches and all the post-judgment execution stuff I was talking about, the PJEs that are filed, and the success rate of some of those PJEs. Just because you file a bank attachment doesn't mean you're going to get any money. You know, even wage garnishments, you could file a wage garnishment and they quit their job the next day, or they don't make enough to hit the minimum standard.
To garnish, yeah.
And you're out of luck. But you know what, client, you got to pay for that still, because that's part of the litigation process. So it's, and I kind of went off on the rails there. I apologize.
No, actually, no. I think what you're bringing up is a really good point, which is about this cost management, right? So, if one of the KPIs that I'm hearing here is the firm's ability to manage costs, right?
Yes.
Whether that be the cost of data, the cost of searches, right? Like the cost of management, but it is all about managing and maintaining that cost. And so, if the firm is filing garnishments that are still costing them money to file, right, and then those aren't hitting, those costs are building up, and then you're managing, I'm assuming, all of these accounts and the associated costs on an individual account basis, right? So there's no like pooling of costs in the consideration here,
Right.
which I think makes it somewhat unique as you look at the agency versus the law firm world, right? Because in the agency world, everything is in a bucket, and yes, through the years we've found better ways to sift the bucket, so to speak, right, with different size grids. But I feel like that's a tough piece. So, you know, from managing that process of kind of looking at those individual accounts, I mean, how does that communication loop work for you in the law firm? So as you're going through that process of how much resource can be spent per account, is that part of your overall KPI? Is that part of a management structure? Like, how do you kind of find that balance?
Yeah, so I'll say two things. First of all, we have some clients that actually give us cost budgets, either on an annual basis or monthly basis, quarterly basis, kind of, you know, you name it. We have all types. We have other clients who do not. Thankfully, most of our clients do not. They let us manage that. When we start a relationship, we say, look, here's a 96-month curve. Net. Here's what we expect to do. And for most clients, as long as we track that, obviously, and share that with them month over month, as long as we're staying on that curve and we're very transparent, obviously, about what we're spending and why we're spending it and how we're spending it, as long as we're staying on that curve, a lot of clients they don't want to micromanage our cost outlay. They understand that there are costs all over the place that are coming in for a variety of reasons. And as long as that, you know, they know going in, all right, we're going to collect X and the cost is going to be 0.2X. It's just the way it's going to be. And some months are going to be higher, some months are going to be lower, but that's just kind of where that middle ground is. So I would say that thankfully a lot of our clients don't want to see like an average cost per account for what they've placed. They just know our cost bucket is filled with X number of dollars that we have to outlay as expenditures, but we can see that our return on cost is 300%, 400%, 500%. And that's the whole reason you start a litigation program. You touched on it earlier. You know, I'm talking about all these legal KPIs, and most of what I talked about, and I mentioned this too, does not apply to agencies, right? Certainly costs do not apply to agencies. We just want to know on the agency side, you know, we placed X number of accounts. We want to see what the return is, and we want to do it compliantly. On legal, we also want to do it compliantly. I want to be very, very clear about that.
Of course.
But there's so much nuance in what you're spending it on. I mean, asset searches, you know, that's not part of the agency nomenclature that no one talks about because you don't have a judgment. So there's just a lot. I guess there are a lot more levers to be moved up and down, and it's something that again we monitor very closely, because you will have situations where a firm is kind of overspending. And what I mean by
Mhm.
that is every 60 days on an account that has paid nothing, let's say, I keep seeing another bank garn filed and another wage garn filed. And so you kind of have to keep your eyes on that and say, hey, look, our
What are you
expense,
chasing?
yeah, and maybe it's on a $1,200 balance. We've spent between suit and judgment and garnishments, we've now spent $600. What are we doing? We're throwing bad
Mhm.
money after good, good money after bad. Sorry, I said that wrong. You're throwing good money after bad because it's a low balance account. Clearly, this person just doesn't have those resources. So
Mhm.
at a certain point, and that's part of our work standards too, is, and I won't go into the details of that, but we have ways to
At some
try
point, you
to
gotta cut
prevent it,
losses.
to try
Yeah,
to prevent that, right? It still happens from time to time, and
sure.
that's okay because it all evens out in the wash. But you want to have some sort of oversight of that to prevent that from happening on a large scale. And
Mhm.
thankfully, I would say typically it's more a firm issue where we have a couple of firms that get a little spindy, and so we have to keep them in check,
Sure.
because again, we are the keeper of the client's assets. We want to do the best by them for them. And if we're spending way too much money and we know we're not getting it back and we know we'll never get it back,
Mhm.
that's a bad thing. We're not doing our part there if that happens. So
No, and so let me ask you this: when you're talking about managing costs, because this is a kind of an interesting vein, but as you're talking about that cost management, right? You had talked a little bit about the client maintaining costs, right, or the client working with you in different ways.
yeah.
Do you kind of pass down similar parameters to the firms, or does that change with you guys? Meaning, so if you've got let's say an annual budget or whatever, are you then dictating downstream what the
Yes,
budget is? Okay.
absolutely.
That makes
So,
sense. I was trying to build a little mental diagram of what was like how this flow worked.
and look, I'll share with you just one client that I have in mind that gives us a quarterly budget. It can be very challenging because I know in every state it costs X number of dollars to file suit, and in this state it
Mhm.
costs 2X to file the same suit, right? And so what we will do for this particular client I'm thinking about is we'll take that money, let's say it's $250,000 for a given month, and we'll divvy it
Mhm.
up to our firms. However, this is a mature portfolio, so I can't give out $250,000 to each firm for filing suits. I have to leave some room because there's post judgment costs, there's
Mhm.
service costs. It's not all necessarily about just that initial suit filing. So what we oftentimes
Mhm.
will do is we'll take about 60% of that monthly budget or that quarterly
Hmm.
budget, divvy it up, give it to the firms based on their placement volume, what their unsued volume that they have. And then the other 40%, we just based on running numbers, right? Running monthly numbers, we're like, we
Mhm.
expect there to be 100,000, 150,000, 125,000 in post judgment costs and service costs that we don't want to dictate when our firms do that. And what I mean by that is filing suit is the beginning of the litigation process. If we
Mhm.
give a firm $10,000 and it costs $100 or $1,000 to file suit in their state, okay, you can file 10 suits this month. However, if the suits that you filed 2 or 3 months ago need service, do it. If they need judgment, do it. We don't want to slow that process down at all. So it's a challenge. It's
Mhm.
challenging to
Yeah.
manage when you have those budgets because I don't know if they're going to submit that service cost today or 45 days from today. And if they submit it today, it counts on this month. If they submit it 45 days from now, it counts towards next month, or 60 days from now, it's now counting towards next quarter. And so with a quarterly budget, it's really, there's a lot of back of the envelope math that goes
Moving
into
parts.
it. And
Yeah, that
it's
sounds like a lot of moving parts.
yeah, a lot of moving parts, and it's very challenging. So that's why we prefer, for any potential clients out there, we prefer you just let us spend what we need to. We promise we'll make it back at the same rate as others that may, try to. And I get it too, especially this time of year. There are
Mhm.
companies that are some of our clients are publicly traded. They have to hit numbers. I totally get it. They want to, reduce costs. They want to make that final number look that much better.
Sure.
So I understand why it happens, but it can be frustrating. It slows down the litigation process a little bit, which
Mhm.
ultimately costs you money down,
Yeah.
looking 4 or 5 years down the road. If you don't sue 50 additional accounts today and you have to wait 6 or 9 months to do it, that's costing you money because
Yeah.
maybe that consumer would have paid you, but You waited 6 or 9 months, they paid somebody else. Now they don't have any money. So
Mhm.
it's, I don't know. I went down a rabbit
I
hole again there.
no,
So
I think it was I think it's a good conversation
yeah.
because what I pull from this is there's KPIs on the dashboard, right? And
Yep.
cost, I'm sure, is one of them, but
Yes.
the level at which cost is being
Yeah.
evaluated and managed from a law firm perspective, and the level of importance that it has, from your perspective as a master servicer, right? And your perspective is the same as the creditors because you're an operational solution for them to handle, like you're almost becoming a department of some of these creditors, right? And
Right.
handling recoveries for them, especially where you're doing both the litigation and the agency pieces. So I
Yeah.
think it's interesting to look behind the curtain a little bit and try to understand how it is that you're looking at some of these, data points. For the law firms that are watching, what advice would you give them to stand out amongst the herd?
Ooh, that's a great question. So if I were looking to board a new firm and I wanted them to stand out, um, I would say I would actually kind of turn around what our entire conversation today has been meant to be about, which is I'm tracking all of these KPIs.
Hmm.
You guys should also be tracking all of these KPIs. You don't want me to ask you why this isn't happening or why
Hmm.
this is happening too much in terms of cost expenditures, right?
Hmm.
You should already know that because you're already tracking all of that sort of stuff and you're making adjustments on the fly too. If you do that, if a firm is doing that, that makes our job so much easier. And not that I'm just looking to have an easier job, but you know what I'm saying? Like, if I
No,
can
it's
trust,
are they being proactive about managing it, or do I have to tell you? It's that
yeah,
to me is that's a fantastic piece of advice, not just for law firms, but for everybody in every job,
everybody. Yeah, for
right?
sure. And it's unfortunately, I will say unfortunately, I think a lot of firms don't do that. They
Mm,
just know what they do. They get the inventory in. They know they need to sue it. They know all the steps to take in their individual states, and
mhm,
that's fine. And some firms can work great like that. Don't get me wrong. If they're really good at putting their nose to the grindstone and getting those things done, that's a pretty good firm. That's sometimes a
sure.
really good firm. But if you're doing that and you're tracking potential pitfalls and potential exceptions of your own organization,
Mm,
that makes you such a better partner for people like us. And if you have direct client relationships, it's so much more attractive to know that you're doing the same work that I'm doing. And so we're checking each other as we're going, right? We don't have to worry about these giant gaps slowly existing and building that maybe we don't see because the firm they're already on it. They know what the issue
mhm.
is and they put in a correction and maybe we never even hear about it. Best case scenario. That's
Well,
fantastic.
or it gets reported with the solution. Hey, we had this
Yeah.
issue, so you're aware of it, and we've already resolved it in these three ways. To
Yeah.
me, that's the
Yeah.
look. That's an email of that's a relationship building email in my book,
Yes.
right? When someone comes to me with that solution as well and can help walk me through it. I think that's a great way to look at it. Wow, this
Yeah.
has been an absolutely awesome conversation, Scott. I really appreciate you coming on and having this
Of course.
chat with me today. I'm hoping we get to do some more of these next year because I think that this is an incredibly important topic, and I think the law firms ultimately want more opportunities, and the clients want to hear more opportunities about how these things are happening. Because I know I kind of kicked this off when we were having sound issues. I was talking. I don't know if you could hear me, but I was talking about building the train tracks right now, right? And so before the wave of inventory comes over the top and crashes on top of us, we're all trying to build these train tracks. And if our train tracks are good, right, if we've got our KPIs in place, we're prepared to manage volume, if we've got all the pieces of the puzzle in place, we can pull as many trains on our tracks as we want, right? Like we can
Yep.
have one train, we could pull all the cars behind it. But if there's any gaps in our train right now, or if there's any gaps in that track, like that's when disaster is going to strike. And I think some
Yeah.
organizations will severely suffer in the coming economic cycle.
Yeah.
Uh, but I do think that there's significant opportunity coming along with it for those that have built those tracks. And it sounds like you guys have not only built the tracks, but now you've got a series of conductors down the line, kind of monitoring progress and making sure the engineers are staying on the path, which is no small feat, my friend,
Sure.
no small feat.
Yes, for sure. Yeah, I agree. And I only heard a bit of that you were saying, but I agree with you. the waterfall, the tidal wave, if you will, of inventory is coming, and we are hopefully prepared for it. Our network is hopefully prepared for it, and we're absolutely looking forward to it. So, yeah.
Well, much appreciated, Scott. I appreciate you coming on today. For those of you that are watching, if you have additional questions you'd like to ask, you can leave them in the chat here. We're going to wrap it up here in a minute, or you can shoot me an email. We'd be happy to respond or jump on a phone call at some point. But thank you, everybody, for joining us today. We really appreciate your time and attention, but we will talk to you all again soon. Thank you, everybody.
Bye-bye.